All right, part two. let's jump into the real cost of financial advice and investments.
Too much Super Bowl.
Yeah, so
New Orleans French coming up.
Well, no, what was that? Hot Shots. Remember? Do you remember the movie Hot Shots? It was
no, I don't remember that.
It's a '90s stupid slapstick movie. And then when they came out with their sequel, they called it Part G. I don't know if I'm saying that right, but whatever. Okay, so last show we really kind of focused on the financial advisor and the cost about that. Now let's start talking about the other investment instruments that are out there. We'll just dig into a mutual fund at first and talk about them, because this is the one, and I've written a bunch of books, and my last published book, Mastering the Art of Financial Planning, I have a whole chapter in the beginning, in the first third of the book, that's dedicated to this. Because when it comes to mutual funds, there is so much garbage. I don't want to call it fake news, misinformation, but it is.
We'll go with lack of transparency.
I will say it is very guided
yes.
into one way of thinking, that mutual funds are very inexpensive. But I will say what is publicized in the information that's out there, if you think about the vast majority of investors' money, I don't know the percentages, I probably should look this up, but it's got to be over 80 to 90% of assets in America are invested in mutual funds.
Oh, yeah. Think about, if you don't believe it, just go look at your 401k options.
Yeah.
Every option is some sort of mutual fund.
Most investors are scared of stocks and they buy mutual funds. Now, we're super comfortable
because mutual funds are just made up of a bunch of stocks.
Yeah. But we're so comfortable with stocks in our firm, we don't even think that way anymore.
Right.
I'm so far removed. I remember as an investment advisor, when I started managing my own clients' money and buying the stocks, I was so scared because I'm like, wow, we're actually going to buy stocks, because there's this persona out there that you could never buy a stock. You need a money management company to do that because you're going to lose your shirt.
Yep. American Funds has more data than you do. So they're going to do it better.
They have all the research. Why would you ever buy a stock? I will say America is getting more and more educated about this, and the fear has definitely gone down. But there's definitely still the vast majority of people that are scared to death to buy the very thing that you're paying somebody else to buy for you. So let's talk about cost. So the biggest cost out there is the expense ratio.
This one they're transparent on.
This is the transparent. So this is basically the cost of the mutual fund. So if you look at any mutual fund in America, they're going to put their expense ratio on their sheet as their cost. So what's the expense ratio for this? There's way more cost than that, but that's the one that's publicized. You might also see their 12B1 fee, which is basically a marketing expense.
Yep. So
if you see a Super Bowl ad or a commercial on TV, that's the 12B1.
That's the funding.
Yeah, that's the funding for it. So they'll carve off 0.25% up to 1% just for marketing of the fund family or that fund.
Yep.
And the expense ratio can be, anywhere from hardly anything up to 2%.
Mm-hmm.
That's what's actually shown to the public. So these two are really shown. You can also have those rare situations where you have a front load. This isn't widely talked about it that much anymore because a lot of people don't buy loaded funds. So you can have, XYZ American Fund or Vanguard or whatever, and you can get it where there's almost minimal fees to hold it, or you can buy it where there's a whole lot of fee up front and then the fees ongoing are super small, or you can buy it where it's super small, but when you get out of it, they crush you. Or you can do it where it's just a very minimal along the way, kind of in the middle.
Yep.
Those become super popular, purchased, kind of around the United States.
Once I became an advisor, I got so angry.
Learning all this?
Because I was told whenever I was in my 20s, use the Roth mindset. He used that, the advisor that I was talking to at the time, like, go ahead and buy the A shares because you'll pay all the fees up front. And little did I know, there were a bunch of other fees that were also being tacked on.
Well, and then
you
weren't keeping that forever. And then every time you sold it, you bought another one. You're like another 5% up front.
It was 5.75. I'll never forget.
You can see the angst on his face. Okay, so let's talk about the hidden cost. We have a lot of other investments to go over. So if you were to Google the real cost of owning a mutual fund, This is the best thing you can do. So you don't have to take my word for it. Go look for the real cost of owning a mutual fund. And then in your search feed, look for the Forbes article. There's a Forbes article called The Real Cost of Owning a Mutual Fund, and it's going to give all of this information. So there's a turnover transaction cost. So if you think about a mutual fund, on any given day, there's probably thousands of people investing money in it, and there's thousands of people taking money out of it.
Yep.
Then you have, in addition to that, monies that are non-qualified, monies that are qualified, monies that are Roth. You have this massive complexity of this huge fund that's just, billions and billions of dollars in the amount of cost of putting money in and taking money out and having float. Like, just the turnover cost, active management, could be in the 1% range, just to sort out that, because the amount of computers, amount of people, accounting that has to go to the IRS.
Yep.
And you think about that, that just doesn't just magically happen. They have to have systems in place.
Every transaction's got some form of cost
that goes back individually just to one person.
Correct.
And the amount of the type of money, I mean, it's crazy.
Yeah.
Then you have cash drag. Cash drag is very connected to this.
Yep.
So you have these turnovers, these buys and sells that happened all the time. Okay. Now they're happening basically twice a day, but it's, potentially tens of thousands in a transaction. And then you have like people the company knows there's money coming in, there's money coming out. So they have their averages. So they keep amount of money in cash because they know they're going to have to liquidate it. But it can't be invested, but they have to show accounting of all the money that they've received and what's the return on that. So you have this complexity of all this money coming in, all this money coming out, and then the company keeping a bunch of cash to make sure that they don't have to sell something. They can just float with this cash. And you can't take somebody else's money that's coming in and feed it out, because that's against the law. So in order to do this, you actually have to float this cash. There's a cost to that, because you can't buy products with, you can't buy investments, you can't invest it. So the cash drag can be 0.5% a year. So you got this transaction cost.
They basically charge you as the client a fee
to manage
for it sitting on the side.
Correct.
Because they're gonna we're gonna make money off of this sitting here. It's
either
just you're gonna pay it.
But not only is there this fee, it's also a lack of return,
which is digging. Yeah, that's the non-transparent part that makes me frustrated too. Is because they may show some of these numbers, these percentages of the fee, and then the ones that are a little more hidden, they're just subtracting it away from your actual return.
Yeah. And then you have the worst one. This is soft dollar agreement, soft dollar compensation. So there'll be a tech company that comes in and is going to say to this company, hey, I want to be a part of this, or the mutual fund company is going to say, we'll refurnish. You have 7 offices across the United States. We'll give you all your top execs. We'll give them a crown, a Cadillac. We'll furnish all your offices with computers, technology, and this is a form of compensation, in order to put their product in the fund. So this is totally legal, where a company can come in, sell their services, not actually charge them, but they'll basically receive all this huge benefit, and it doesn't get documented. It's an agreement. You want to get really irritated about mutual funds? It sounds like we're digging on them. We are. But look up soft dollar compensation, and it'll make your blood boil on how something so inappropriate is legal in our space, where you can do backdoor agreements, get all this kind of crazy stuff, and you don't have to report it. And it's a legitimate cost to the fund. You're getting this money, this stuff, but it comes at a cost. Ugh. So you start throwing all that together, you're looking at somewhere between 3 and 4% annual cost of a mutual fund. Then let's talk about ETFs.
Let's move along.
Thank goodness these aren't as bad. You have the same expense ratios, but they're much lower.
Yeah.
And the biggest reason that these are lower is you're taking the human element out of it.
You're basically setting it up, putting it almost to an algorithm, right?
Yep.
And then just, here you go.
Yep. You're setting it. You're setting and forgetting it.
Yep.
So the biggest issue that you're going to have here is the fact that whatever the ETF is doing, and typically ETFs are following some existing model because they're digital. So most ETFs aren't new. They're like, hey, we're going to follow the S&P, or we're going to follow this industry or whatever. And they're designed to follow something. So there's always going to be a lag because you can't get it exactly.
Right.
And it is an algorithm or some computer. The expense ratio is going to be almost nothing to 0.75%.
Yeah.
Okay. And then you're going to have the same type of issue inside of it where this the buys and sells, but this is very electronic. They still have the same headache, but it's much more automated.
Right. Yeah.
So it's not as bad, but there's still an additional cost for the ins and the outs because it's a pool of money. So you have this big fund, this big ETF, and there's all this money coming in, all this money coming out. It's much better run and organized with technology. It's much more individualized, but there's still going to be that cash drag, that issue in an ETF that you're going to have in a mutual fund. And if there's one glaring thing that's coming out of this discussion so far is, why would you pool your money with somebody else? Like there's so much potential loss, extra cost and loss because it's not individualized.
No, this is one of those things where the fund manager or however they design the ETF, it's strictly designed to make money for the company ultimately. Yes, they want to help you along, but we're going to make our fair share out of all of this. It's not unique to your situation. They're not trying to, generate income or a return for you.
And I will say there's another thing. If you Google ETFs, you have this bid-ask spread. So you have all these people, all this money coming into this ETF and or mutual fund. The same thing applies to mutual fund. We're like, hey, one of our positions is this stock. And you're going to have the stock going at, $1 a share, just making a price. Because we're coming with so much money, you might be able to get it for 97 cents. Who gets that spread? So if the company using all this money, it's selling for $1, but you bought it for 99, 97 cents, where's that excess money going to? Most of the time, that goes to the broker dealer, the company. They don't have to disclose what they bought.
Pay those commissions.
That's right. That's how they're free.
Yeah.
Because they're making so much money on the spread and nobody sees it. There's no disclosures on that. You don't know what it was going for. You just see the ticker selling for $1, sell it for $1, but you didn't know that they bought it on Wall Street for 97 cents. That applies for mutual funds. That applies for everything. That actually applies when you're in an individual account with somebody like us, because we're buying it, somebody else is buying it, mutual funds buying it. We have no idea, and we're never going to see it. This industry is super walls up everywhere. And how do you have an industry that used to charge commissions that all of a sudden now the commissions go away and they're more profitable than ever?
Right.
How did this happen?
So are they just keeping it in-house? Is that what?
Oh, yeah. There's so much money that nobody sees.
Right.
There's a reason when you walk into a massive institution like a Schwab or a Fidelity and there's marble everywhere.
Right.
It's not because they're free.
That's right.
It's because they're making money.
Yep.
And, it's just, this is a tough show to go over because you can see the frustration and like we're in the business.
Yep.
We charge a fee and it's almost impossible to get around where I would love to get all of my clients' money back to them, less our fee. But literally it's almost impossible to do that because there's so many other hands in the cookie jar that we need them. Like, I'm not going to take money. Like, I will never be a custodian.
Right.
Like, I'm never taking clients. Like, that's how Bernie Madoff became Bernie Madoff, because he accepted funds. He kept them in his own bank account. And then corruption
and he pulled
ensued.
them all together, right?
He pulled them all together.
Yeah.
Never happening. We're always going to have this issue. I don't want any temptation. Let's talk about annuities. Annuities are a fun one.
You're past.
So yeah, a lot of pass on annuities here. So when it comes to annuities, there's a typical M&E. So this is mortality and expense. This is what you'll normally see in any type of annuity. Now there's two basic types of annuities. You have a fixed annuity or a variable. A lot of what I'm going to talk about right now is variable expenses. If it's a fixed annuity, you're going to have an M&E. You might have rider charges and surrender charges if you leave early. So your M&E is typically 1 to 1.5%. Rider, if you purchase one, could be about 0.75% to 1.5%.
And that'd be like an income rider, death benefit.
It could be anything. It could be long-term care. I mean, a rider could be For income, it could be a death benefit. It could be an additional something.
Okay.
So if you think about Disney, so their rider on their ticket is the line skipping.
Gotcha.
What's it called?
That Fast Pass.
Fast Pass. That's a rider. So my ticket is to get me in the park. I can add a rider on it and get this other benefit.
Gotcha.
So a rider is just an additional benefit of a cost.
I can go eat dinner, or I can have that character dinner.
Yeah. But you think about the college tuition. Like, I'm paying for my class. There's also room and board.
Yep.
Which you don't have to do.
Oh,
Which is a rider. You know, the meal plan.
Yep.
That's a rider. So riders exist everywhere.
Sure.
Okay. When you fly on the airlines.
That bag.
Rider's a bag, right? You want that bag to come with you? It's going to be an extra cost. Unless it's Southwest. Bags fly free.
Which I think they have it down. They just bake it into the cost of the flight.
That's weird. So M&Es, mortality, you got 1%. Riders are about basically another average of 1%. Surrender charge only comes into play if you leave early. So those three, you might have an administration cost is across the board, whether it's fixed or variable. That's like a 1/10% to 0.5%. I mean, we're super expensive right now because you're looking at, if you don't have a rider, you're looking at basically 1 to 1.5% annual costs to own this annuity.
Yep.
If it's a variable annuity, you're looking at an extra 0.5 to 2.5% for investments, which are mutual funds. So they're going to buy these mutual funds inside of these annuities. So you're going to have, up to 4% a year for a variable annuity. They say a picture's worth 1,000 words. Yeah. Like I'm not a fan of mutual funds. ETFs, if I had to buy anything as a pooled investment, sure, I still wouldn't. And then annuities right now, variable annuities, a heck no. Fixed annuities, you can find a place and you can get them pretty cheap.
How did they expose their fee, or do they at all? Like, because, if you hand an advisor $100,000 for your annuity, when you go look at your account, it's $100,000. And I'm not supposed to lose money on this investment, right?
You have to look at it's not a prospectus, but they're going to give you like your contract, and everything's in your contract.
Okay.
So you can see their mortality and expenses. You can see their administrative. You're not typically going to see it up front, although you can ask. Best way to do is to call the company themselves and ask them these questions, like what's your M&E, what's your administrative, what's the sub-account fee, what's your rider, what are all the riders and what are their costs? What is the surrender? Like, you ask them these questions and then they answer and you're like, you start adding it up and you're like, dang, I thought my 100 was my 100.
Yeah.
And you're like, yeah, well, wait a year.
Right.
And then you see all those fees come out and you're like, dang.
It's going the opposite direction.
Yeah. So, and I do have a lot of experience here. I'm not saying annuities are bad. I'm not saying anything is bad.
There's
just a lot of cost that goes along with this.
You need to know what you're getting into.
CDs. CDs are pretty easy. We're going to spend like 35 seconds on these. The only fee is really the spread of money that goes bank to bank.
Okay.
So CDs are basically pools of money that banks are lending to each other, and they're basically saying, hey, I need your 100 million. I'll give you this much interest on it because we have a liquidity issue at our bank, or vice versa. Or they're going to the feds. I mean, it's basically interbank lending.
Yep.
And that's how they come up with these rates. The only thing that you don't see is how much the banks are making. It's off your money. It happens all the time. Like, as a business owner, I have a business checking in America. Like, businesses own or have so much cash and banks don't pay. We're talking about investors and all you care about is your checking account. And the banks give personal investors tons of options and return on your cash. Mm-hmm. They're using all the cash of businesses
that are sitting there, right?
And they have no return on cash. Yep. I mean, nothing. You can have stupid amounts, millions, hundreds of millions of dollars. Yeah. And you know what they're doing? They're giving the individual investors
your 4%.
Rates on it. On that, which is great. I'm not upset about it. It is the way it is. But there is definitely cash
that goes on. Coming from, right?
Correct.
Yeah. They're taking that $1 million and making 5% on it and passing along forward to you in a CD.
And there's the bank is making a lot of money off of the cash that they're not using.
That's right.
And they're giving it to the investor, but they're making more than they're giving to the investor. So there's still a cost. You're just never going to see it. Who cares?
Yeah.
Is the way I see it. The business owner cares, actually. And then the last thing that we're going to talk about really quick is basically stocks and bonds. Principles there are, it's just the spread. It's the stuff that you can't see, you're never going to see.
The cost of access, right?
That's it.
Like if you want to go and purchase a stock, you just got to understand that Charles Schwab or whoever,
they're going to make money on your transaction.
E-Trade, whatever it is,
they don't charge you a commission anymore, but there's definitely a transaction cost that goes along with it. And there's nothing you can do about it.
There's a reason that banks are the largest buildings in most major cities.
So what are some last thoughts on this?
I just think, not to say poo-poo any of these, but you should know. Like, if you're going to go to the store and you're going to buy something, whatever that shirt or pair of jeans or shoes, you should know the cost of it. And if you find value in it and that's how you want to manage your own assets, then best of luck.
Yeah.
But at least know and have a real idea of the full picture of what that's costing.
Yeah, for me, this is a value proposition. It's an understanding, it's a knowledge of really understanding how this industry works and how there's cost on the advisor side and there's cost on the investment side. And once you understand that, you can really come to grips of, okay, is what I'm paying worth the value I'm receiving? Whether you have an advisor or don't, whether you have this investment or that investment, is the value proposition, does it make you feel good or should you go a different route? That's it for me. This isn't bad or good. I definitely have feelings on annuities and mutual funds and different things, and I'm pretty opinionated on it. But that doesn't mean I'm right. It just means I'm opinionated. So everybody has to come to grips of how they feel and where they see value and just move forward. This has been good. Yeah. This has been fun. Hope you enjoyed yourself.